Welcome to the Deep Dive. Today we're going to crack open the financial reports for Microsoft. We're looking at their first quarter for fiscal year 2026. That's the period that ended September 30, 2025.
Yep.
And we've got all the key documents here, the earnings release, the presentation slides, even the full 10Q. Our mission, really, for you listening is pretty focused. We want to follow the money.
Right.
Microsoft keeps talking about this huge long-term push into AI infrastructure. So we need to see where exactly are those investments showing up. Are they just massive costs dragging down profits, or are we, already seeing the big revenue payoff?
Well, the top line numbers certainly suggest a payoff is definitely on the horizon. Total revenue for the quarter came in at $77.7 billion. That's an 18% jump year over year, or 17% if you look at constant currency.
Pretty strong numbers.
Very strong. And operating income was also exceptional. It grew 24% to hit $38.0 billion. I mean, these figures really blew past expectations.
Okay, but right away, we kind of hit the core issue, the tension point for this whole discussion, really. If you just look at the basic profit and loss statement, the AI story hits you hard. Their GAAP net income, that's the official accounting standard, it increased a healthy 12% up to $27.7 billion. Okay? But then you look at the non-GAAP net income, which, strips out certain costs like investments, that surged 22% to $30.8 billion. That's a really significant difference.
It is. And what's fascinating, I think, is that gap. It's almost entirely explained by the cost tied to their main AI partnership. The net losses from their investments in OpenAI totaled a staggering $3.1 billion just for this quarter.
$3.1 billion.
Yeah. And just to give you some context, that single expense, $3.1 billion, it resulted in a $1.41 decrease in their diluted earnings per share.
Wow. So that's basically the price tag, right? The cost for building out their future AI dominance.
Yeah.
And they're expensing it all immediately. It really hits those GAAP numbers. Was there any talk about why expense it all at once? Why not maybe capitalize that investment over time, smooth things out a bit?
It really seems like a very deliberate strategic move. By taking the hit immediately on these huge partnership costs, they're signaling a couple of things. First, they're being transparent about the cost, what it actually takes to build this AI factory. And second, they're showing the sheer scale of investment they're willing to make, even if it hurts the reported profit in the short term.
Right.
And just for comparison, remember that $3.1 billion loss this quarter. It's 6 times higher than the $523 million loss they had in the same quarter last year. So yeah, the pedal is definitely down.
Okay, pedal is down. Let's shift focus then to what that investment is actually fueling. Let's talk about the cloud engine, which includes Azure. The total Microsoft cloud revenue was $49.1 billion. That's up 26% year over year.
Huge number.
Huge number. But the figure that really catches my eye, the one that signals that long-term future success, is the commercial remaining performance obligation, the RPO. This is basically signed contracts for future work, right? Revenue that's locked in but not yet recognized.
Yep.
That RPO jumped an absolutely astonishing 51% year over year. It hit $392 billion.
Yeah, a 51% jump in RPO is, it's market moving. It gives them incredible visibility going forward. It tells you customers aren't just, buying Azure month by month. They're locking in these massive, sometimes decade-long deals, often driven, I think, by needing that huge AI compute capacity down the line.
Makes sense.
So looking specifically at that intelligent cloud segment, the revenue hit $30.9 billion, growing 28%. And the star within that, no surprise, is Azure and other cloud services revenue. That grew 40%. Driven by, strong demand across the board, but especially for those consumption-based AI services.
40% growth in Azure.
Yeah.
And you can really see the strategic shift when you compare that to the sort of legacy parts of that same division.
Exactly. Server products revenue, that's things like Windows server licenses, it barely moved, just 1% growth. And that tiny increase was mostly just a temporary bump from people buying Windows Server 2025 ahead of time. So yeah, all the momentum, and you have to assume almost all the investment focus, is clearly on that high-growth Azure side.
Okay, so Azure is growing at 40%. Sounds amazing. And that $392 billion RPO, it really signals dominance. But there's always a but, right? Where's the catch in the financials?
Yeah, the catch is the cost of building the factory, as they say. Despite that incredible revenue growth you just mentioned, the cost of revenue for this cloud segment jumped 43%.
43%. So cost grew faster than revenue.
That's right. And this huge increase in cost, outpacing the revenue growth, it directly pushed the segment's gross margin percentage down.
So they're literally pouring billions into building out the infrastructure.
They absolutely are. The documents specifically point to the impact of scaling the AI infrastructure and, the growing usage of AI features as the reason for that margin pressure. They are clearly prioritizing getting the capacity and scale built out over protecting margins right now. Though they did mention some efficiency gains helped offset it a bit. But this is the core tension, isn't it? Sacrifice immediate segment profit to build the scale needed for that massive long-term AI opportunity.
Okay, let's switch gears then. Let's look at the core business segment productivity and business processes. This is Office, Dynamics, LinkedIn. This is where we should start seeing how those expensive AI features are actually being monetized. Segment revenue here was $33.0 billion, up 17%. Pretty solid.
Very solid. And the key number to watch in this division is the Microsoft 365 commercial cloud revenue. That also grew 17%. But here's the really critical detail, I think. That growth wasn't just volume. It was primarily driven by higher revenue per user.
So they're not just adding more seats, they're getting existing users to pay more money. Significantly more, it sounds like. How are they doing that? Is it just forcing people into the pricier E5 bundles, or is Copilot already making a real difference in pricing power?
It looks like both, but Copilot's premium seems to be working. The report explicitly mentions the growth driver as the move to higher price bundles like Microsoft 365 E5 and, crucially, Microsoft 365 Copilot.
Okay, so confirmation.
Yeah, it confirms the AI premium strategy is delivering exactly what they hoped. And we know this because the actual number of users, the Microsoft 365 commercial seats, only grew 6%. So think about that. They're getting 17% revenue growth out of just 6% seat growth. That's a fantastic sign of their pricing power and the value people see in those add-ons.
That really is textbook elasticity, isn't it? They can raise the effective price significantly, and demand holds up because of the perceived value. What about the other parts of that P&BP division?
The consumer side of Microsoft 365 is also doing well. Revenue there grew 26%, helped by 7% growth in subscribers. LinkedIn revenue was up a healthy 10%, mostly from their marketing solutions. And Dynamics 365, their ERP and CRM offering, that increased 18%. So strong demand across the board there, too.
All right, now we get to the final division, more personal computing. This is usually Windows, devices, Xbox. And yeah, this was the slowest grower this quarter. Revenue up just 4% to $13.8 billion. What's the story behind that relatively sluggish number?
Well, it's a bit of a mixed bag. Windows and devices revenue combined was up 6% overall. The boost actually came from Windows OEM revenue, that's licenses sold to PC makers. That was up 18%.
18%? Why so high?
It looks like a classic cyclical bump, demand driven by the looming end of support for Windows 10, which forces companies to upgrade their fleets. But that Windows surge was partly canceled out by their own hardware, the devices revenue. Think Surface, which declined.
Got it. So a boost from the OS refresh cycle, but their own Surface hardware is still finding its footing, maybe.
Yeah.
What about gaming? Xbox is a huge piece of this segment.
Right. Gaming revenue overall was actually down 2%. Xbox hardware revenue fell quite a bit, down 29%.
29%. Ouch.
Yeah, it reflects that predictable slowdown in console sales as this generation gets older. And Xbox content and services revenue only eked out a 1% increase, mainly because they were comparing against a really strong quarter last year.
Okay. Were there any bright spots on the consumer side, maybe advertising?
Absolutely. Search and news advertising revenue, this is excluding the traffic acquisition costs, showed really strong growth, up 16%. That was driven by good organic search volume and also continued success with their third-party partnerships, so a healthy performance in that specific ad market.
Okay, let's try and tie all this back together. The big picture. Capital flows, investments, and the associated risk. We saw that $3.1 billion expense hit the income statement from OpenAI. But where's the actual cash going? Where are they spending to build the physical capacity?
Yeah, you see that clearly in the capital expenditure or CapEx numbers. They are exploding. Additions to property and equipment were $19.4 billion this quarter alone.
$19.4 billion. In 3 months.
It's a truly massive investment. That's a $4.5 billion increase just from the $14.9 billion they spent in the same quarter last year. And this reflects that intense high-speed investment in new data centers, networking gear, specifically to support this huge AI build-out.
$19.4 billion. That really is the cost of building the AI future, written right there in the cash flow statement. And yet, even with that astronomical spending, their cash generation is still phenomenal. Net cash from operations increased 32% to $45.1 billion. Free cash flow grew 33% to $25.7 billion. I mean, even while building this giant factory, they returned nearly $11 billion, 10.7 billion to shareholders.
Yeah, the balance sheet is still incredibly strong, which allows them to make these huge foundational bets. But, the story got even more interesting just after the quarter closed. On October 28th, 2025, they announced a new definitive agreement with OpenAI.
Ah, right. Tell us about the sheer scale of that new deal.
Well, the headline number is pretty staggering. The new agreement includes a provision for OpenAI to purchase an incremental $250 billion of Azure services.
$250 billion.
Quarter of a trillion, yeah. And beyond that, the deal clarifies Microsoft's stake. They now hold approximately 27% in the Public Benefit Corporation, the PBC, that OpenAI formed.
Okay, that $250 billion future commitment from OpenAI is just monumental. It doesn't just guarantee future revenue, it practically dictates the pace Microsoft has to build out its cloud infrastructure for years. So with stakes that high, what kind of risks are they highlighting in the 10Q? What are they worried about with this accelerating AI push?
They're quite clear about the risks, actually. The 10Q specifically calls out the potential for liability from intellectual property claims, things related to the data used for training AI models or the output generated by those models.
Okay, IP risk. What else?
They also noted internal risks, things like flawed algorithms or using biased data sets, which could lead to poor performance, bad outcomes, or even reputational damage. And then maybe the most costly thing in the near term, they flagged the complexity and the expense of just keeping up with the changing global regulatory landscape. They specifically mentioned things like the EU's AI Act and potential changes or new rules in the U.S. impacting AI diffusion. It's like they're building the plane while regulators worldwide are still designing the safety standards for it.
Right, a very dynamic situation.
Oh.
Okay, so let's wrap this up. What does this all mean for you, the listener? Our deep dive into Microsoft's Q1 FY2026 financials paints a very clear picture, I think. We're seeing this deliberate, absolutely massive commitment to AI infrastructure. And yes, it's putting pressure on their margins and driving these immediate short-term investment losses, like that $3.1 billion hit from OpenAI.
But that spending is the fuel, isn't it? It's directly driving that exceptional high-value revenue growth we talked about. You see it in Azure's 40% climb, and in their ability to charge premium prices for things like Copilot, effectively getting huge revenue per user gains from their existing base. So yeah, the cost of building the AI factory, it's very clear in the exploding CapEx and the pressure on cloud gross margins.
But then you look at that $392 billion in contracted future revenue, the RPO. That signals this high-cost, high-investment strategy is already paying off. It's locking in future business and demonstrating real pricing power.
Which leads us, I think, to the final provocative thought for you to consider. Given that newly revealed $250 billion incremental Azure commitment just from OpenAI, how much faster will Microsoft's already soaring capital expenditures, remember, $19.4 billion just this quarter, how much faster will that need to accelerate just to meet that single, massive, locked-in future demand? It really sets up a race between building capacity and deploying capital that's going to define their next 5 years easily.